Last week, we started to see some of that post-election rally start to fade, with red nearly right across the board. We had two industries that were hit the most. We have the semiconductor space with quite a significant number of stocks down double digits, notably Broadcom and Micron Technology. And in the pharma space, we had big names down, again double digits, AbbVie negative 17%, Eli Lilly more than 10%, as well as many others. Now, one of the reasons for this, if you are someone who did watch yesterday's episode, then you will know, but essentially a lot of the vaccine maker companies have started to crumble as Trump has chosen RFK Jr. to lead the HHS, which is essentially the Department of Health and Human Services, and the reason why the stocks have fallen is that they do believe he is a vaccine skeptic and will essentially affect a lot of the market and hurt the top line of companies like Pfizer, like GSK, and many others. Now, if you want to listen to Jim Cramer, although bear in mind lots of investors have made tons of money by doing the exact opposite of what he has said, he believes that this won't really in the ultimate long run have an effect on junk food, as that is also affected, as well as the drug industries. Now, in terms of the actual fear and greed index, it has started to move into the neutral space. We were in greed just last week, but remember, market sentiment does move incredibly quickly, something just to bear in mind. Now, today's episode, we're focusing on 5 undervalued dividend stocks, pretty much at their 52-week lows, and they look incredibly cheap. We're going to discuss each one in detail. We'll look at the company, we'll look at their expectations on the EPS historically moving forwards, and as always, we'll touch upon some very important metrics, not just their dividend safety score, but dividend yield theory comparison against the 5-year forward P average, as well as running into a lot of significant financial metrics that you need to understand for every single one of these. Don't forget, we will put each one through the valuation model, getting to our own intrinsic value, as well as the margin of safety we believe they have, 10, 20, 30, 40%, as well as the upside that Wall Street themselves see over the next 12 months. So the first one we're jumping into is Lam Research Corporation. As we said, it is trading at its 52-week low. We also notice a double buy rating from Seeking Alpha and Wall Street. Quant do give this company a hold. In terms of forward yield, 1.31%, and the forward P sits below 20. For context, S&P around 25.5. Now, over the last 12 months, pretty much flat as we can see. Just over the last month, though, this company is down nearly 20%. Although if you have been holding this over the last 10 years, you would have massively outperformed the S&P 500, up 812%. And we can see all-time highs, in fact, in 2024, not long ago, around the $113 mark. Now, good news about Lam Research. Over the next 4 quarters, they are anticipating double-digit increase to the EPS, and just look at their historical forecasting accuracy. They've outperformed 4 out of 4, 100% track record, which gives us faith for their next full annual accounts. The EPS of 4.23 should be hit, then in turn lowering the forward P to 16.57. Now, in terms of the financial metrics, we'll start off with dividend safety at 66 safe. We'll talk about these two models, but they do show severe undervaluation, and we love to see this, a double-digit increase, in fact 15% in August this year. So the safe score was reaffirmed just last week, ultimately meaning for Lam Research, a dividend cut is unlikely. How did they perform in the previous recession? 07-09, great recession. In fact, no dividend, no comparative data. They had below average growth, negative 55, S&P itself negative 12, and they did also marginally underperform the S&P, negative 64, the S&P negative 55. Now, we love to see this 13% increase year on year over the last 5 years, 46% over the last 10. Definitely a great dividend growth company, and we can see they have been increasing those dividends for the last 10 years on a consecutive basis. Now, the first model that we are looking at here, when we do zoom into over the last 12 months, we actually notice for the majority of the period it's been trading in severe overvaluation territory. Right now, in fact, for those that don't know, the blue tunnel is the expected fair price. Right now we sit trading right below the lower end, giving us that severe undervaluation signal. Just remember though, we're not looking at any one of these models in isolation. We will conclude towards the end of the episode. Now, in terms of dividend yield theory, tells us a company is undervalued when the current yield sits above the 5-year average. 1.31 above 1.17, you could argue reasonable valuation, you could argue undervaluation. In terms of the forward PE, it is marginally lower, 19.2 than the 5-year rolling, so again you could argue the same, reasonable / slight undervaluation, but we do note it is significantly lower than the information technology sector as a whole, so Lam Research is trading at a discount to the sector. Whether or not it is warranted or the market has overreacted, again something we can look at and apply a margin of safety. As always on this channel, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 50%, reason why we have a target, giving us faith management can continue with those very attractive double-digit increases. 50% for semiconductors, well below that every year. 25% in 2024, there or thereabouts over the next 12 months. So we wouldn't be surprised, August in 2025, we do anticipate another double-digit increase. We do love to see this on the free cash flow side, consistent increases over the long term. Yes, a little bit inconsistent, nonetheless moving in the right direction over the longer term, and an increase is expected over the next 12 months, continuing that upwards momentum. Then we get to the sales growth. Remember, this is a cyclical industry and we haven't seen much of that through the numbers, which is a good sign. However, we can see 2 of the last 10 years, notably the more recent 2024, where we do get that negative 14% drop to the top line. Nonetheless, it has in fact tripled on the numerical basis, 5.3 billion in 2015 to just under 15 in 2024. They also do what we love to see, returning excess cash to investor pockets through those share buybacks. Yes, a little bit inconsistent. Yes, they did dilute your position over 2016 to 2017, but over the longer term, they have been reducing it, a very good sign. And when you combine that with the double-digit increase, definitely a great opportunity to consider for the portfolio. We then move on to ROIC, one of our favorite metrics, above 12%, absolutely strong. In fact, 31 in 2024, 34 on a trailing 12-month basis. And the reason why we love this metric so much, it essentially gives us faith that management are able to effectively allocate their capital. Now, if you're a regular viewer, you know on the margin, we don't just want to see the minimums applied. We want to see operating efficiency, revenue increasing, margin increasing. We're seeing that here, 17% in 2015, 29% in 2024, and their free cash flows absolutely gorgeous, well above that minimum 5%. In fact, 31 on a trailing 12-month basis. And these metrics will really show good signs to investors as well as those who are considering adding. We then move on to the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see, and these are the numbers of years that it would take the company to pay off all of their debt net of cash on hand. In fact, 0 in 2024, 0 on a trailing 12 months, 0 over the next 12 months. It wouldn't take Lam Research one day to pay off all of their debt net of cash on hand, and this correlates to dividend safety, balance sheet strength, therefore in turn showing us that their balance sheet does look to be good, and a lot of really good metrics. I'm very impressed with Lam Research today. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the intrinsic value today, $98, is just the average of these 3 models, and when we do our deeper dives, we do run into every single one talking inputs and outputs. Today, we're getting straight to it, and our intrinsic value at $98, in fact, as we can see, not too common on this channel, but pretty much in line with where Wall Street see this over the next year. Their price target, $98, they see upside of 40%. And as always, on this channel, we apply an MOS, where we start off with 10%, execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, a buy at $88, then we keep going till it's near the current trading price. And what we can see in today's episode for Lam Research, not quite at the 30% point yet, but you're getting between 25 to 30% with Wall Street, as we can see, very bullish, 40% over the next year. And as always, give us your thoughts. Is this one you're looking to buy? Maybe one you own but you're holding, or in fact, you do want to sell? Let us know below. Now, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning, so a new one is coming tomorrow, where we discuss severely undervalued stocks that deserve your attention, as well as what's gone on in the market over the last few days. So click below, sign up, and you can start reading straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a copy of 22 undervalued dividend stocks that Wall Street believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. Now the next one we have is CP Canadian Pacific Kansas City Limited, but we do want to make you aware we would have also included CNI Canadian National Railway, which is actually our more favoured company, but given we have reviewed that not too long ago, we will talk about CP, which we do also like. Now, in terms of where it sits, towards its 52-week lows, a double buy signal from Seeking Alpha and Wall Street, a hold from Quant, a forward P around 24.6, and we can see here a forward yield of 0.73%. Now, over the last 12 months, up around 3.4%, just over the last month, in fact, down around 9%, and when you zoom out over the last 10 years, it is up around 81%, but bear in mind two things. One, this doesn't include dividends reinvested, so it would be up a little bit higher, and two, this is if you had bought, in fact, exactly 10 years ago. Now, in terms of their earnings expectations, well, out of the next 4 quarters, in fact, they're expecting all of them to be positive growth. However, 3 of them double digit, which is nice to see. Although historical forecasting accuracy, they only have a 50% track record, with a more recent miss in that latest quarter of Q3 by 2 cents. Nonetheless, they're expecting growth over the next full year annual accounts, essentially lowering the forward P to 20.84. Dividend safety, well, 76, so it does look to be safe. And one thing that we do have to make you aware is that they haven't increased that dividend in quite some time, so not a priority for management in terms of their capital allocation. We then move on to the key metrics where they actually maintain the dividend, didn't increase, didn't cut during the last recession, average growth, and also marginally trailed the S&P negative 64. Now, whilst they haven't increased the dividend since 2020, we still know over both the last 5 and the last 20 years, they have been on average increasing the dividend at a very attractive rate. Hopefully, this is something we will see them kickstart again very soon. And here is noted 21 years of paying a dividend without a reduction. Now, in terms of the expected fair price over the last 12 months, we can see right now it is trading towards the lower end, so you could argue reasonable / slight undervaluation purely on this metric. And then in terms of dividend yield theory, in fact, we get that reasonable signal again. Yield right now, not far off the 5-year rolling, and the forward P, again, something very similar. 21.6 is only marginally lower than the 5-year 22.9, and we can see marginally higher than the industrials overall at 20.3. So what about the free cash flow payout? Well, look, below 60% is our blanket rule. Below 60% is exactly what they've done year on year. 20% over the next 12 months. So we would ideally like to see a nice increase at the bare minimum just to keep up in line with inflation at the 4 percentage point. Free cash flow per share, well, it has increased more than double over the last 10 years, but this industry, again, is fairly cyclical, and we can see that through the numbers. There is no consistent increase. Nice to report, over the next 12 months, growth is anticipated more than double 2023's free cash flow per share. We then see that cyclicality come through the top line revenue as well. Some years negative, some years flat, some years like 2023 looking very, very good. And from a numerical perspective, pretty much doubled their top line from 2014 to 2023. One thing we do have to note, they were historically doing those share buybacks from 2014 to 2021, but given the merger from Canadian Pacific and Kansas City, we do notice that shares outstanding has increased, so it will be interesting to see, based on this, whether they continue buying back shares like management had historically done, and we will see that pretty much right across their numbers. That is why it is affected from over the last few years. Otherwise, historically, their ROIC numbers have looked very good above that minimum 10%. In terms of operating margin, well, very strong, well above the 12% minimum. A little bit of inconsistency, but we would like to see this start to climb back up. The lows of 39% not seen since 2015. And then we get the free cash flow margin, absolutely no complaints whatsoever with these numbers. In terms of the net debt to EBITDA, again, the merger did increase that, in fact, dramatically from 2.4 to 4.9 in 2021. Good to see though, this is part of management's capital allocation, delevering the balance sheet, bringing it down to 2.88 on a trailing 12 month, so below the 3, and expected to continue to go down. But do bear in mind, this industry, railroads, is typically where we see companies have a lot of debt, so something just to bear in mind. In terms of the valuation, well, our intrinsic value is $84 in today's episode, but Wall Street very bullish. They have a price target of $94. They see upside of 27%. And when we get to our MOS in today's episode, at 10%, a buy at around $76. At 15%, not quite there at 72, so sitting somewhere between 10 to 15%. We do like Canadian Pacific, but when we did run the numbers in a previous episode, CNI did look like it was better valued, larger MOS with better upside. But again, both companies for the long term do look very strong. Give us your thoughts. Maybe in fact you do prefer one to the other, or other companies like UNP, which are also strong in the railroad industry. We then move on to Mondelez International, where we get our first strong buy from Wall Street, a buy from Quant, and today it is seeking alpha, giving this company the hold, trading at its 52-week low with a yield just below 3%, a forward PE just below 19, and we can see over the last 12 months down around 8%. In the more recent period, over the last 30 days alone, down 10%. If you zoom out over the last 10 years, up around 65. In terms of the expectations, well, bear in mind something we need to flag. Over the next 4 quarters, they are expecting a decrease to the EPS overall. Nice to see though, historical forecasting accuracy 100% and outperformed every quarter, and over the next full year a small drop to the EPS is expected, therefore a small increase to the forward P. And very similar to Hershey, Mondelez does have issues around the high cocoa prices, and hopefully that is something that will start to reduce and help their top line as well as their margins. We can see the dividend safety looks good at 66, a double undervaluation signal, and we note here a nice 11% increase in August 2024. And ultimately, in terms of the last recession, they maintained the dividend, they had below average growth, and they also significantly outperformed the S&P, negative 35%. Love to see that increase in August this year. Love to see the average over the last 5. Little bit disappointing that drop to over the last 20 years. And when we do zoom out, we can see Mondelez has been increasing those dividends for the last 10 years. So what about the valuation based on the forward PE? Well, what we do notice here is that it is trading right towards the lower end, so you could argue undervaluation or in fact reasonable valuation, but trading towards the lower part. We then move on to dividend yield theory, where we get a severe undervaluation signal. What makes it severe here is the highest yield they have offered over the last 5 years, and the dividend does look to be safe, no concerns of a cut. In terms of forward P, another undervaluation signal. The average is higher than the current 19.7, although we do note it does sit higher than consumer staples at 18.1, so trading at a marginal premium. In terms of the free cash flow payout, well, below 70% for consumer staples, pretty much what we see at least for the last 6 years and expected over the next 12 months. Then moving on to the free cash flow per share, love to see this growth over the longer term, more than doubled and expected to continue that upwards trajectory. Sales growth, yes, some years aren't that great, although good to report over the more recent period, the numbers are looking very attractive. 2% on a trailing 12 month, so hopefully they can at least in 2024 just keep in line with inflation. Then we zoom out and we can see the struggles that they have had in terms of increasing their top line. But what is good to report though, they have been doing a lot of share buybacks on a consistent basis. Yes, it's not a lot straight off the bat, but every year they do seem to be doing this as part of their capital allocation, on top of that nice 11% increase to the dividend year on year that we have seen over the last 5. Now, consumer staples, we increase it to around 12%, which we do actually obtain from this company, not just 2023, but also on a trailing 12-month basis. And then when we look at margins, we also get a sign of efficiency. Great to note, although above 16% has only been accomplished in the more recent period. 12 in 2014, 17 in 2023, and a trailing 12 month. And love to see the consistency on the free cash flow margin over the last 6 years, around the 10 to 12% point. So what about the net debt to EBITDA? Well, what we do know is that it has been below 4 since the peak of 2017, coming down consistently 2.33 and expected there or thereabouts over the next 12 months. No worries whatsoever with the dividend or that balance sheet. And when we take a look, our intrinsic value today, pretty much in line with Wall Street, their target over the next year, they see 25% upside. And when we run it through the MOS, 10% a buy at 73, at 15% a buy at 69, and at 20% pretty much where we see this today. Mondelez 20% MOS, 25% upside. Give us your thoughts, buy, hold or sell. Then we move on to AstraZeneca, a company that has been hit similar to others in the industry. Now we were thinking about this one or GSK, however we went with AZN today due to the fact that the upside did look significantly better. We have a buy signal from Seeking Alpha, a buy although not far off a strong buy 4.5 for Wall Street, and a hold from Quant. Now as we can see, trading at the 52-week low, a forward yield of 2.35%, a forward P of 15.4, pretty much flat over the last year. Over the last month though, we can see down nearly 20%. Over the last 10 years, up around 70%, although we can see all-time highs were hit just under $90 at the end of August this year. Now, very good to report, over the next 4 quarters, every one positive EPS, however 3 of 4 being strong double digit, which is great to see. And out of the last 4 quarters, 75% track record, last 3 in fact in line or at least a nice beat. In terms of the next full year, well, EPS is expected to grow and the forward P is coming down even lower if hit at 13.22. Now we get a safe dividend score, and in terms of their dividend growth, we are waiting for an increase in the more recent period. So when we take a look at this company's metrics from the last recession, they increased the dividend, they had positive growth, which is great to see, and they also significantly outperformed the S&P. Now dividend has been a little bit slow in terms of the growth, 1% year on year over the last 5, although over the last 20, still looking good at that 7% point. And they have also been paying out a dividend for the last 24 years without a reduction. Now in terms of their forward P, over the last 12 months, we actually notice it has gone from severe undervaluation to reasonable valuation, back now in the more recent period to severe undervaluation, something that in fact we can see when we take a look at the forward PE, as it is trading at 13.6, well below the 5-year 18.8, although the dividend yield theory, given the fact the yields aren't too far off each other, does imply here that this, based purely on this model alone, is reasonably valued. In terms of the healthcare sector though, it does trade more at 16.1, therefore AstraZeneca PLC is trading at a discount. Now good to see that it is below 60% for the free cash flow in the more recent years, because 2019, 2020 and some years before it was at the triple digit point, something you can't see from the earnings payout. And what this implies is that management paid out more in dividends than they generated in free cash flow. Nice to see 66 in 2023, expected to go 43 over the next 12 months, so hopefully we can see an attractive increase to the dividend. And we also notice, whilst inconsistent, free cash flow has been increasing over the period and expected to increase sharply over the next 12 months to $6.89 per share. We also notice from their top line inconsistencies, you could argue perhaps cyclicality, but over the last 5 years looking very good. 14% on a trailing 12 month is also very, very strong. And when we do zoom out, nearly doubled their top line, although they had periods where it was very, very stable. In terms of shares outstanding, one thing we don't really want to see is when companies issue shares diluting your position. This is something we have note for AstraZeneca on this graph. In terms of ROIC, again inconsistent, but nice to see on average at least straddling around the minimum 10%. In fact, from the lows of 2021, it has started to increase. 18% on a trailing 12 month is very, very strong to see. We then look at their operating margin, where we can see efficiencies increasing over long term, but again unfortunately there are inconsistencies or patches of inconsistencies throughout the period. Free cash flow margin looking a lot better though. In terms of the net debt to EBITDA, again decreasing from the peak of 3.55 in 2021, 1.44 over the next 12 months expected, so looking very good in terms of the balance sheet and dividend safety for AstraZeneca today. Now our intrinsic value at $87 will give a nice margin of safety. At 10% a buy at $78, at 15% $74, and we keep going. And what in fact we note today, if you are buying this around the $65 mark, you're getting a 25% MOS. As we said, Wall Street very, very bullish. They're nearly at that strong buy point. Their price target just under $94. They believe AstraZeneca is a good buy with 42% projected upside over the next year. We then move on to TotalEnergies, where we get another strong buy rating, this time from Seeking Alpha, with a buy from Wall Street, a hold from Quant, trading at its 50 or in fact towards its 52-week lows, with one of the high yields today at 5.5%, one of the lower forward Ps at 8, and over the last 12 months down 10%, over the last month in fact down 6.14, And if you do zoom out over the last 10 years, up only 2%, although if you were someone who did manage to grab this at the COVID lows, you would have paid $25. You would be up more than double the price right now, sitting at 61. In terms of looking at the forecast, bear in mind, oil and gas, it is cyclical, and out of the next 4, we notice 2 of them to be positive, 2 to be negative, but management not looking the greatest. They only have a 25% positive track record, missing 3, and in fact, the more recent 2. Nonetheless, they are expecting growth to the earnings per share, lowering the forward PE in December 2025 to 7.37. Dividend safety, first one we sit at borderline safe, so we can touch upon. Nice to see an above inflationary increase at 6.8% for a company that does pay a yield at the 5.57 percentage point. So borderline safe was reaffirmed just a few days ago, and this effectively means there is a moderate risk of a dividend cut over a full economic cycle. Now, last recession, they maintained the dividend. They had below average growth, but they still managed to outperform the S&P. And in terms of growth over the last 5 years, around the inflation rate, over the last 20, again, very similar. Not something to complain about if you are getting a yield around 5.5 to 6%. And then we can see only 2 years of consecutively increasing those dividends. So what about taking a look at this theory here? And in fact, over the last 12 months, trading towards the upper end, if not above that period in terms of valuation, we can see right now in the middle, therefore reasonable valuation signal. In terms of dividend yield theory and in fact forward P, both here mirroring each other, telling us that essentially the averages are where this company is at today's date. Although we note it does trade at a massive discount to the overall energy sector P at 15.2. In terms of free cash flow payout, well, over the more recent years, it is below the 40% that we want to see for oil producers. 54, so an increase expected over the next 12 months. Not a massive one, but perhaps something to keep an eye on. And then we get to the free cash flow per share, where we can see it has been increasing from 2017 nearly 3 times, although we can see expected to drop. And remember, cyclical companies, we will see a lot of peaks and troughs in the numbers, and ideally you want to be buying them when they are out of favor. Again, cyclicality shown through the numbers. 6 of the last 10 years, including 2023, the top line has reduced, and that is shown on the numerical format here. In terms of shares outstanding, well, they have diluted your position, although very marginally, from 2.28 in 2014 to 2.35 in the latest quarter. But one thing to note, from 2021, they have started to do share buybacks, and it looks to be something that management are allocating their capital, especially just over the last few years. ROIC in the more recent period looking good, above the minimum 10%. Some patches, though, we do note inconsistency. Again, something to think about, especially when we apply a margin of safety. Operating margin straddling around the 12%, looking good over the more recent years, and free cash flow looking pretty much historically very attractive from 2017. Now, net debt to EBITDA, something to keep an eye on, especially because we did see that borderline safe score, but it is below 1.5 over the last 3 years. A marginal increase expected on the trailing 12 month to the next 12 months. So again, still below 1.5, but again, lots of things that we are just indicating so that you can take a look for your own investment thesis. Now, intrinsic value at $91, when we put it through the MOS, at 10% a buy at $82, at 20% at $73, and in today's episode, you are in fact getting an MOS around the 35% mark, around the $60 price. So whether or not it is one for you to consider, 35% MOS, 34% upside from Wall Street with their price target of $81, and we did see that one strong buy rating. As always, give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for TTE or any others, and come and join us in the Patreon where we do discuss our weekly buys and sells. And don't forget, sign up to the free weekly newsletter. We are dropping a copy to your inbox tomorrow morning. As always, have a great day, and we'll see you all on the next one.